Did you know that in Canada, your bank account can now be frozen without a court order? That's right. You don't even have to be convicted of a crime. Just being linked to a protest or flag transaction could be enough. In fact, under new federal measures, everyday Canadians are waking up to find their money suddenly out of reach, not by hackers, but by government powers once reserved for extreme emergencies. And it doesn't stop there. New laws are quietly expanding behind the scenes, from increased surveillance on crypto wallets to digital IDs that track your financial habits. Some experts are warning that we're entering a new era of total financial control, where even side hustles and personal savings could become government business. If you thought your money was safe in the bank, you might want to think again. So what's really going on? Are these laws about protecting Canadians or controlling them? In this video, we break down 10 powerful new laws that are changing how your money works in Canada and reveal the practical steps you must take to protect yourself. Stay till the end, because what you don't know could cost you everything. Number 1. Financial surveillance is growing fast. Canada's financial monitoring agency, FINTRAC, has been given a quiet but powerful upgrade, and it's watching more than ever. Under recent changes, banks, credit unions, insurance companies, and even cryptocurrency platforms are now required to report every suspicious transaction, not just the big ones. While the $10,000 threshold still applies for automatic reporting, new technology allows authorities to flag transactions under that amount if they appear unusual, and what qualifies as unusual is getting broader by the day. What this means is simple: your day-to-day transactions, a large e-transfer, moving funds between accounts, or even buying crypto, might now be logged and reported without your knowledge. The government says this is to combat money laundering and terrorism financing, but critics argue it's becoming a system of mass financial surveillance. The CRA and FINTRAC now work more closely than ever, sharing data and building detailed profiles of taxpayers' financial behavior. The danger? Even innocent people can get flagged. A sudden deposit from a family member, an investment withdrawal, or cash-heavy business earnings might attract attention. Once flagged, you may face frozen accounts, audits, or lengthy investigations, and there's very little transparency in the process. The key takeaway: your financial privacy in Canada is rapidly shrinking, and you may not even realize it until it's too late. To protect yourself, keep thorough documentation of all transfers, avoid mixing personal and business finances, and speak with a financial advisor if you regularly move large sums. The age of anonymous banking is over, and the digital trail you leave could come back when you least expect it. Number 2. Crypto is no longer private. If you thought cryptocurrency was a safe, anonymous way to manage your money, think again. In Canada, new anti-money laundering (AML) laws have completely reshaped the way crypto is treated. Digital currency exchanges and platforms are now considered money service businesses, which means they are legally required to register with FINTRAC, report large or suspicious transactions, and verify the identities of their users. The same rules that apply to traditional banks now apply to crypto, and in many cases, the regulations are even stricter. These changes mean the days of buying or trading crypto under the radar are over. Every time you move a significant amount of Bitcoin, Ethereum, or any other digital asset, the government can know about it. And because crypto transactions are recorded on the blockchain, that information doesn't disappear, it's permanent. With new monitoring tools and data matching systems, the government can now trace your transactions and connect them directly to you. Even peer-to-peer transactions between wallets are not completely safe if one of them is tied to a regulated exchange. This shift doesn't just affect big investors. It hits regular Canadians who dabble in crypto as a side hustle, long-term investment, or even a method of sending money abroad. If you've ever used platforms like Coinbase, Binance, or ShakePay, your activity could already be flagged or monitored. So what can you do? First, make sure you're reporting your crypto gains on your taxes. Second, consider separating your wallets for different types of transactions, and always keep records. And finally, stay informed, because the government's ability to track and control digital assets is growing faster than most people realize. In Canada, crypto is no longer the financial Wild West. It's now part of a tightly controlled system. Number 3. Tax reporting rules are getting stricter. In recent years, the Canada Revenue Agency, CRA, has been quietly tightening its grip on personal and business income reporting, and 2025 brings even more aggressive policies. If you earn extra income through freelancing, online sales, renting out a room, or even flipping furniture on Facebook Marketplace, the CRA now expects you to declare every dollar. Third-party platforms like Airbnb, Etsy, and Uber are now required to report your earnings directly to the government, meaning you might be getting audited without even knowing it. The CRA is also cracking down hard on international accounts and undeclared assets abroad. New agreements with other countries allow Canadian tax authorities to automatically receive financial data from foreign banks, exposing hidden savings or investments. Penalties for incorrect filings have jumped sharply, and even honest mistakes can trigger costly consequences, including frozen accounts, interest charges, and legal threats. The message is clear: there's no more room for error or avoidance in the Canadian tax system. So how can you stay on the safe side? First, start treating all side hustles and freelance work like a real business. Track income, save invoices, and set aside taxes from the start. Second, don't rely on platforms to handle it all. You're legally responsible for reporting your total income, even if a company sends data to the CRA. And third, if you have foreign holdings, consult a tax professional immediately to make sure you're fully compliant. In today's climate, it's not enough to be honest. You have to be thorough. The government has the tools, the data, and the laws it needs to audit almost anyone. The only question is, are your finances ready if they come knocking? Number 4. Hidden owners must now be revealed. For years, it was easy for individuals to hide behind corporate structures, using numbered companies, trusts, or holding corporations to own real estate or operate businesses without disclosing their identity. But that loophole is closing fast. Canada is now implementing beneficial ownership registries, which require corporations to publicly disclose who really owns and controls the business. That means the days of anonymous ownership are officially numbered, and the consequences for noncompliance are severe. This change is part of Canada's effort to fight money laundering, tax evasion, and shady offshore dealings. But for everyday business owners, it creates a new layer of exposure. Whether you're a small landlord, a family business, or an investor using a holding company, you'll now be required to report accurate and up-to-date information about the individuals who ultimately benefit from your corporation. The registry will be accessible by law enforcement, financial institutions, and in some cases, even the public. This shift is already active in several provinces and is expected to expand nationwide. If you use corporations to manage assets, this law directly affects you. Now is the time to review your legal structures and ensure your documents are clear and compliant. Work with a lawyer or accountant to properly declare beneficial owners and avoid unintentional violations. Even minor errors could lead to fines or audits. And if you were relying on a company to keep your identity private, that strategy is no longer safe. In the new financial era, transparency is not optional, it's required by law. Whether you agree with the policy or not, ignoring it could cost you far more than you think. The government isn't just watching, it's keeping a list of who owns what and who's trying to hide it. Number 5. Digital currency is coming. The Bank of Canada is actively developing a central bank digital currency, also known as the digital loonie, and it could change the way Canadians use money forever. While it's still in the testing phase, the groundwork is being laid quickly. This digital currency would work much like cash, but entirely online, issued and controlled by the central bank. On the surface, it may seem like a modern, convenient step forward. But behind the scenes, it introduces a powerful new tool for financial control. Unlike physical cash or decentralized cryptocurrencies, a central bank digital currency is programmable. That means it could, in theory, be controlled or limited based on how, when, or where you spend it. Imagine money that expires if not used in time, or spending restrictions applied during emergencies. Sound far-fetched? These are real features being discussed by central banks around the world. In the wrong hands or under the wrong policies, this level of control could allow the government to monitor and influence nearly every transaction you make, from your grocery choices to your donations. So what can Canadians do? First, stay informed. The digital loonie isn't in your wallet yet, but public feedback and pressure can shape how it's rolled out. Second, diversify your assets. Relying solely on digital currency could be risky if restrictions are ever applied. Consider keeping a portion of your money in physical cash, precious metals, or even non-government-controlled crypto for flexibility. And finally, ask yourself this: how much control should any government have over your wallet? The digital currency revolution is coming fast, and if you're not prepared, you could wake up one day to find your money doesn't move unless someone else says it can. If this is opening your eyes, let us know in the comments. What shocked you the most so far? We spend hours digging deep to bring you the facts no one's talking about. So if you're finding value, support us with just one click. Hit that subscribe button and stay ahead of the curve. Number 6. Emergency powers over your bank account. One of the most alarming financial shifts in Canada came after the 2022 convoy protests, when the federal government invoked the Emergencies Act and used it to freeze the bank accounts of individuals who were simply suspected of supporting the demonstrations. No criminal charges, no court order, just suspicion. That moment marked a historic turning point. For the first time, Canadians saw how quickly access to personal money could be cut off by executive action, and how deeply politics and finance could become entangled. While the Emergencies Act was lifted, the precedent remains. The ability to target individuals financially, whether through direct government action or pressure on financial institutions, is now a real and legal possibility. In fact, recent legislation has made it easier for the government to work with banks to monitor and act on financial behavior, especially when tied to security threats. But what qualifies as a threat? The definitions are vague, and that's what makes this so dangerous. It could extend far beyond protests to donations, affiliations, or even controversial opinions. To protect yourself, it's time to think beyond just traditional banking. Consider diversifying your financial footprint, holding accounts in more than one institution, keeping some emergency cash on hand, or even exploring alternative assets like gold or cryptocurrency can add a layer of insulation. The goal isn't to panic, it's to be prepared. Because when your ability to pay bills, buy groceries, or access savings depends on political stability, you're not financially free, you're financially vulnerable. The recent use of emergency powers was a warning, not a one-time event. If it happened once, it can happen again, and next time, it might affect people who never saw it coming. Number 7. Real estate is under heavy scrutiny. If you're buying, selling, or holding property in Canada, there's a growing list of new rules and taxes you need to know about. In recent years, the government has rolled out a series of measures aimed at cooling the housing market and cracking down on so-called unproductive real estate ownership. That includes the vacant home tax, anti-flipping rules, and new foreign buyer bans in several provinces. While these policies were introduced to make housing more affordable, they've also made real estate investing more complicated and risky for everyday Canadians. One of the most significant changes is the anti-flipping tax, which now treats profits from homes sold within 12 months as fully taxable business income, not capital gains. That means higher taxes and fewer deductions for anyone who renovates and resells property quickly, even in personal situations like job relocations or family changes. Meanwhile, homeowners with secondary properties or vacation homes in cities like Vancouver or Toronto could face thousands in new taxes if the property is left empty for too long. The paperwork and compliance burden has also increased, with stricter reporting rules and higher penalties for mistakes. To navigate this shifting landscape, property owners need to be more informed than ever. If you're considering flipping a property, be prepared for the tax implications and ensure your records are bulletproof. For those owning additional homes, make sure you understand the local vacancy rules. Ignorance won't protect you from fines. And if you're a landlord or investor, now is the time to revisit your strategies with a tax professional. What worked 5 years ago might now trigger a CRA audit. The message is clear: real estate is no longer a hands-off investment. It's being watched, taxed, and tightly regulated like never before. Number 8. Side hustles are under the microscope. Gone are the days when a little side income could fly under the radar. Whether you're driving for Uber, selling on Etsy, freelancing online, or monetizing a YouTube channel, the Canada Revenue Agency is now actively monitoring the gig economy like never before. New policies require digital platforms to report users' earnings directly to the CRA, which means if you've earned money through any of these channels, even just a few $100s, there's a good chance the government already knows about it. This increased scrutiny is part of a broader effort to capture tax revenue from the fast-growing digital economy. And it doesn't matter whether your side hustle is a part-time job or just an occasional gig, every dollar counts in the eyes of the CRA. The real danger lies in assuming you're too small to notice. Even small amounts of undeclared income can trigger audits, penalties, and years of back taxes. Worse, many Canadians unknowingly make mistakes, like forgetting to track business expenses or assuming they don't need to register a business, and end up paying more in the long run. So what should you do if you're earning extra income on the side? First, treat your hustle like a real business. Keep receipts, track income and expenses, and consider using accounting software. Second, report all your income, even if you think it's too small to matter. The CRA is now using automated systems to match data from third-party platforms, so mismatches can easily get flagged. And finally, if your side hustle is growing, talk to a tax advisor to make sure you're structuring it properly. The gig economy offers freedom, but in Canada's current financial climate, that freedom comes with responsibility and risk. Number 9. Your bank data will be shared. Canada is preparing to roll out a system called open banking, and while it's being marketed as a way to give consumers more control over their financial data, the reality is more complex. Open banking allows financial institutions, apps, and third-party services to share your banking data, with your permission, to offer personalized financial products or advice. But as this system becomes more widespread, the line between convenience and exposure becomes dangerously thin. Once your data is out there, controlling where it goes and who sees it becomes nearly impossible. What's especially concerning is that this isn't just about spending habits. Open banking could expose your entire financial profile, including income, debt, credit history, loan applications, and transaction patterns, to multiple entities. And although it's supposed to be secure, data breaches are always a risk. Worse, consent is often buried in fine print, and once you've agreed, the data can be shared across platforms with little oversight. The more connected your financial life becomes, the more vulnerable you are to tracking, profiling, and even manipulation. So how can you protect yourself in this new financial environment? Start by reading the terms and conditions of any financial app or service you use, especially those offering free tools in exchange for access to your bank accounts. Choose institutions that are transparent about data usage and have strong cybersecurity measures in place. And most importantly, only give permission when absolutely necessary. Just because open banking is becoming the norm doesn't mean you have to accept full exposure. In today's digital world, your financial data is as valuable as your money, and if you're not careful, it could be used in ways you never intended or agreed to. Number 10. Wealth and luxury taxes are on the horizon. Canada is seriously considering a set of new wealth and luxury taxes that could reshape how high earners and asset holders manage their finances. While these proposals are often framed as targeting the ultra-rich, the reality is that middle-class Canadians could be caught in the crossfire. Plans being discussed include taxes on luxury vehicles, secondary homes, personal assets over certain thresholds, and even an annual wealth tax on net worth above a proposed amount. These aren't just political talking points anymore. They're showing up in federal reports and public consultations. The issue is that the definitions of luxury and wealth are shifting. A second property, a paid-off family cottage, or a vehicle valued over $100,000 could soon be considered taxable luxuries. And because asset values fluctuate, especially real estate, more people are finding themselves on the radar without realizing it. These taxes may start small, but history shows they tend to expand once introduced. In other countries, wealth taxes have quickly grown in scope, dragging more people into higher tax brackets over time. To prepare, Canadians need to assess how exposed they are. If you own high-value assets, it's time to consider how those holdings are structured. Could a trust protect part of your estate? Is it time to downsize or redistribute assets among family members? And most importantly, stay engaged in the public conversation, because these tax changes are still being shaped. Contact your MP, follow federal budget announcements, and be proactive, not reactive. What's being framed as a fair share could quietly become a major financial burden on ordinary Canadians. The tax system is evolving fast, and those who aren't paying attention could find themselves paying far more than they ever expected. Canada's financial system is changing, not gradually, but rapidly and often quietly. From digital currencies and expanded surveillance to stricter tax rules and wealth redistribution, the rules of money are being rewritten, and ordinary Canadians are at the center of it all. These aren't just policy shifts. They're deep structural changes that affect your daily life, your savings, your investments, and your financial freedom. And the most dangerous part, many people won't realize what's happening until it's already too late. But awareness is your greatest defense. By understanding these new laws, you can take control of your money before the system takes control of you. Whether it's reviewing your taxes, diversifying your assets, or simply being more intentional about where and how you bank, every small step matters. This isn't about fear. It's about being smart, prepared, and proactive in a system that no longer rewards passivity. Because in this new financial era, those who stay informed will thrive, and those who don't may find themselves locked out of their own wealth. If this video opened your eyes or helped you in any way, let us know which point surprised you the most in the comments. We read every single one. Your voice matters, and so does your support. We pour a massive amount of research, writing, and production into every video to bring you value that others overlook. If you want to keep seeing this kind of content, please support us with just one click. Hit that subscribe button. And don't forget to check out our other videos to stay ahead of the curve. Until next time, stay informed, stay sharp, and protect your future.